let me take a step back. 2 weeks ago, I was in Thailand, and I was at a hotel that was only 14% occupied. That same hotel last year, they told me, was 70% occupied year over year. So why the drop? Chinese just aren't going to Thailand right now. They're scared of kidnapping. They find prices too high. So they're staying in mainland China, which is why I'm extremely bullish for Legoland, because Chinese consumers don't want to travel to the United States or Europe. They don't want to travel to Thailand. So where are they going to go? The best deals in the country right now are in mainland China. So Legoland is really hitting that desire for domestic tourism, and it's also not cheap. So even though there's the D word, or deflation, that's hovering over the country, Chinese consumers are willing to spend when they see value. And they see value in opportunities to educate their children. They see opportunities to create experiences and memories with their children. Legoland is going to do exceptionally well in the coming 6 to 12 months, just as Universal Studios has done very well in China since it opened 4 years ago.
Great point. So experiential consumer trends are holding up and even outperforming. On the other end of the ledger, if the emphasis really is on value from the Chinese consumer, Starbucks is underperforming. What is that telling you about discretionary spending, Shaun?
Well, the value is the real term, and I'm glad that you brought it up. Chinese households are still sitting on 20 trillion US dollars of savings. It's all in time deposits. They're not putting money into the A shares. They're not buying real estate. They're just sticking it in and getting 1-2% interest rates in time deposits. But they still have the money. They're just not spending on certain categories because, as you just said, a lot of the big companies like a BYD, like a Xiaomi, like a Xiaopeng are discounting. So Chinese consumers are taking a wait-and-see attitude before they buy into most categories. But for some categories, they'll spend money, like sports apparel. You can see Hoka, Lululemon, On are all booming. Now, when it comes to Starbucks, I think Starbucks is making major strategic mistakes in China, and they've done so for the past 5-6 years, frankly. It's not because of the weak consumer spending. It's because they've lost their brand positioning. Starbucks used to be luxury in a cup. You used to go into Starbucks, talk to the barista, have a nice place to sit down. I used to see a lot of construction workers 20 years ago. They would line up and spend, 3 days worth of their salary to get a Starbucks cup, to get luxury in a cup and show the world they were sophisticated. Over the last 5-6 years, Starbucks remained expensive, but their outlets are terrible. I went into a Starbucks 2 weeks ago and 40% of the items on their menu, the high-end coffees, weren't selling. So it just was a really bad experience. And so what Starbucks is trying to do is they're trying to cut prices. They're trying to compete now on price against Manor Coffee, against Luckin Coffee, and that's something you just can't do. As an American company, you can't compete with Chinese companies on price. They'll go to lower margins. You see the CEO of Starbucks is making hundreds of millions of dollars a year. So how can they really compete on price? They need to double down on a more premium in-store experience, better coffee, and really regain that luxury in a cup feeling that they had a decade ago, Sri. I'm very bearish on Starbucks right now. It's terribly run in China. Hopefully, Hill House or Primavera or Fountain Vest, one of the big private equity firms, can buy them and have decision-making localized at the CEO position. And if a PE firm buys them, make me CEO, because I think I can turn around Starbucks in China.
You make quite a stark prediction. If Starbucks can't win in China, they won't be able to survive in America. What leads you to that conclusion?
Well, it's pricing. So I actually just arrived back from the United States yesterday. I was in Boston yesterday. And you see inflation is still a major problem, even though egg prices have come down, even though gasoline prices have come down. When I talked to Americans over the last week, the high price of everything was something that American consumers talked to me. They said they were worried about tariffs. They were worried about the uncertainty and the mercurial nature of Trump's decision-making. Nobody had any trust in Scotty B or Scotty Bessent to run the economy, so they're looking to save their dollars too. Now, Luckin, China's large domestic coffee company, has just entered the American market. And I think Luckin can do very well if they can compete on price against Starbucks, because the American consumer, just like the Chinese consumer, frankly, is hurting. The major difference between the two is when the Chinese hurt, they save. When the Americans hurt, they go out and spend on experiences and on alcohol to try to feel better about themselves.
can you tell me why you're also bullish on PopMart, which is a toy company listed in Hong Kong, and it's known for selling these highly sought-after, collectible, almost designer toys in a blind box? Maybe I'm too old-fashioned or just simply too old to full stop, but where is the merit in that?
PopMart has been one of my biggest calls for the last 3-4 years. The reason is, even though the economy in China is okay, you see retail sales have gone up 6.1%. Unemployment has dropped, especially amongst youth, down to about 14-15%, down from the 21.9% 2 years ago. The economy is slowly improving. You see green shoots in the economy. However, Sri, there's still a lot of anxiety. A lot of consumers, especially those in their 20s, don't want to work hard. They're lying flat or tanping because they feel they're never going to be able to get rich. They're not going to be able to afford a house. They're not going to be able to realize the go-go economy of the last 20, 30 years. So for these consumers, they're anxious and they're really saving their money, except for on items like a Legoland experience or on PopMart's Labubu and some of their other items, because it makes them feel good. So in the United States, when there's a weak economy, look at the lipstick effect. A lot of American women, if they can't buy La Mer and expensive products, they'll still spend a lot of money on upgrading their lipstick. In China, it's little toys. So when you go into office buildings, like a lot of the young women in my company, they all have PopMart figurines lined up on their tables. And what I found is, during the COVID era, when the restrictions on our movement or the amount of COVID tests we had to take every day went up, my employees started buying more PopMart figurines because it made them feel good. Now, you got to remember, those figurines aren't cheap. They're about 60, 70 RMB for a little doll. So people will spend money. Secondly, Sri, as I mentioned before, I was just in Thailand. When I was talking with young women in Thailand, they all said to me they love PopMart. And they asked me if I could buy figurines for them in Shanghai and send it to them in Thailand. And
so
quite a few of them actually were telling me it's absolutely going to go global. A lot of these girls said they were going to fly into China to buy the figurines. I think PopMart is at a very early stage of becoming kind of like a mini Disney. They've got the IP. They can have, like a Legoland. I think PopMart, 5-10 years from now, could have a theme park or an amusement park. Absolutely, PopMart's a winner. Fits exactly the Chinese consumer mindset right now, spending to feel better because of the anxiety.
Looks a bit like a cross between a troll and a Cabbage Patch Kid, if you remember those from the 80s. I certainly do. Shaun, in China, like India, is not a monolithic consumer market, is it? So just tell us what's going on in the rural economy, in Tier 3, Tier 4, Tier 5 cities, which are not just recovering, but we're seeing a very strong demand story there. What's going on compared to the rural centres?
That is a great question, Sri, and I think that's one of the best questions a journalist has ever asked me. Here's the problem. When you read the Wall Street Journal or you read Bloomberg, they talk about how weak consumer confidence is. That's because they're typically interviewing people in Tier 1 cities like Beijing, Shanghai, Shenzhen, Guangzhou. But here's the thing, Sri, and I'm glad you asked me this. When you go into Tier 3, 4, 5 cities, the consumer confidence is actually rising there. Consumer spending, purchasing power is also growing. So investors should be backing companies that are expanding quickly into 3rd through 5th tier cities. That's the future of China. There are about 400 middle-class Chinese right now. We expect that number to swell to 800 million over the next 5 years. You want to stay away from brands like Louis Vuitton, like Gucci, like Burberry, that have too much of their store count in Tier 1 cities, because that's where there's anxiety, that's where there's weak confidence. But going to the 3rd through 5th tier cities, I'll give an example. I just spoke with one of the biggest sports apparel companies, and they're talking about maybe engaging my firm to develop a strategy, not even for 3rd through 5th tier cities, but 5th through 8th tier cities, because that's where they're seeing growth, while they're seeing a major weakness, nagging, continuing in the Tier 1 cities.